All right, so just as an introduction, I'm Frank. I'm the tax partner at CKH, CPAs and Advisors. I've been a tax, student from my early days, and then basically spent 20 years with the firm and learned a few things on the way. So I'm hoping I can give you some information that is going to be helpful. I run basically our tax team. I also run our payroll team, and I run our accounting team. So I have 3 little divisions underneath me, but tax is kind of the core of that, and I kind of get a kick out of doing it. So that's lucky for me. Umesh, you want to introduce yourself?
Yeah, my name is Umesh Patel. I've been in the tax industry for the last 30 years, preparing financial statements, individual tax returns, corporate financials, gift taxes, you name it, I've done it. So I've got to bring a lot of experience to the field, and hopefully we can give you guys some tips here on small businesses and some of the common mistakes to avoid.
Very good. All right, so a quick agenda. We'll run through the 5 mistakes. We'll run through the key takeaways and contact details. We'll give you our contact details at the end, and then we'll also have some Q&A. I just need to keep our internal counsel happy at the office. Make sure that I tell you that this is not to be considered tax advice. This is general information. If you do need specific tax advice, please see a tax professional. It can be us or your own tax professional, but just that disclaimer. There you go, Nick. Covered our legal piece. All right, just to kick off here. As a show of hands, which one of these is causing most pain in your life? Is it bookkeeping? Anybody? Yeah. Tax preparation? Got a couple of those too, and then payroll processing. How about all of them? Yeah, that's what I say. Who's got a rotary cuff injury and suffering through it? Me. All right. Accountant's humor. All right, let's run through our first one. The first mistake that I come across, and it drives me nuts, is my folks don't talk to me before they make a decision. And I've listed here 10 different things that could potentially severely impact your tax position. I'm not going to read them all out to you. They're there. I'm just going to pick up a couple of them. So selling an asset, a significant asset, is obviously going to have a significant tax impact on you. It's going to impact the thresholds at which your deductions and credits may be phasing out. So very important item there. Another one that's also become very in vogue and very relevant lately is your expansion into other states. So you might say, hey Frank, look, I just sell stuff, man. I've got a website and I sell all these widgets, and I don't even do anything in California. I sell them some stuff, but that's about it. Well, there's been a couple of court cases. Initially started out with Wayfair, which impacted sales tax only. And basically the decision out of that case was that if you sold more than $200,000 of produce or product into another state, that state had nexus to tax you for sales tax purposes. So the states all saw this and said, fantastic. We can now establish that this person is doing business in our state. Let's move across to income tax. And now you have a plethora of states that are saying, hey, you sell X much dollars of product into my state. I'm going to treat you as working in my state. I'm going to tax you. I'm going to tax your profits, and we're going to fill our state coffers. So very important to be careful of that. It's no longer just the case where, hey, I have an employee in that state, or I use my truck and I drive my goods to that state, or I have a physical office in that state. There's this concept of economic nexus has become very prevalent. So here's where I give you an example of this exact type of case where not talking to your tax preparer gives you a little bit of heartburn. So I've got Mike, client of mine, been a client for about 3 years. He walks into my office over the summer. He says, Frank, guess what? I made a ton of money. I just sold one of my rental properties. And I said, yeah, that's great. What's the tax going to look like? He said, don't worry about it. I've got that covered. I've heard about this 1031 exchange thing. And I say, Mike, you're too late, buddy. If you're going to use a 1031 exchange, you have to have identified the replacement property that you're going to buy within 45 days of the closing. And so he had missed that deadline. He had missed the boat. and ended up paying capital gains tax on the sale of his rental property. Again, a simple phone call to your tax preparer, and that would have resolved. We wouldn't have had that issue. So, Umesh, if you want to pick over with
so
the best
what's
practices?
the best practices with this, or that you learn? You want to go ahead and talk to your CPA before making any major tax decision regarding your small business. Consult with them, ask them, what are the tax consequences if I do this? What are the tax consequences if I do the other? I have a client of mine actually this week who called me and said, hey, I'm in bankruptcy. And this is the same client that 2 years ago had profit of about $500,000 on his books. And what he did, instead of taking the money and accounting for the times where he would have had a lean time, like now, the next 3 months, he's got no revenue coming in. But he took all of his money and paid down all of his debt to the equipment that he purchased. I would have advised him that don't pay all your debt down, at least keep some money for operations. Had he had listened to me, he would not be filing bankruptcy right now. So very, very important that you talk to your consultant or your CPA before making any sort of major tax decisions. You want to know what are the tax consequences related to those decisions. And each client has their own specific situation, so we can't just give you a random answer. You have to come and consult with us or consult with your CPA, and they'll provide what's the best answer for you.
And just to reiterate there, make sure you're getting qualified advice. So, TikTok's great for entertainment, really bad for tax advice. My biggest competitor is your next door neighbor. He knows best. And I have clients walking in countless days saying, hey, I had a talk with my next door neighbor and he's doing X, Y, Z. He's going to save a ton of tax. And I said, yeah, well, good luck when the IRS comes and examines him. But just make sure you're talking to someone who's qualified. All right, second big mistake, missing out on tax benefits. So how do we figure out what our tax is going to be? We take our revenue, everyone knows that, that's always consistent. But there's three kind of elements to how we get to our net tax result. The first one is your tax deductions. So these are the expenses that you're going to reduce your revenue by to come out to an amount that we're going to apply your tax rate to. The second one of those is tax credits, and those are dollar for dollar deductions, right? So if you have a $5,000 tax bill after you've taken off all your tax deductions and done your calculation of tax, then if you get a $1,000 credit, your tax bill is going to be $4,000. It's dollar for dollar reduction. And then the final one is incentives. So these are things where if you get yourself if you do a lot of good homework and you get yourself a good advisor, you can find opportunities to save tax. And an example of that would be maybe setting up business in an opportunity zone, for example. Georgia has wonderful credits where if you hire individuals in an opportunity zone and you keep them for a specific period of time, you're able to get very significant tax credits. So worthwhile exploring all of those and certainly asking your tax preparer for that. So what type of tax deductions are we looking at? Again, I've got people like Mike who come to me and say, hey, I just bought this new Ferrari. Is that a tax deduction? And I say, well, it might be. Do you use it more than 50% in your business? He says, yeah, of course I do. I drive and I go and take my clients to fancy lunches and I pick them up from the airport in it. And to an extent, if that is what he does and that is his only use or main use of that vehicle, sure, why not? The amount that you can deduct, though, is a little bit limited. So what you might be better off doing is buying a truck, which is more than 6,000 pounds, which you actually need for your business because you're in construction. And you can then get a much better accelerated depreciation using that 6,000 pound limit rule. So yes, there are things you can do. There are better things that you can do. Again, talking to your accountant is probably going to give you a little bit of more guidance. But what I wanted to do specifically with this, and I've listed a couple of the expenses that you can claim, your expenses that you want to claim for a tax deduction need to meet the IRS code. And the IRS code says that it needs to be reasonable, it needs to be ordinary, and it needs to be necessary. So what does that mean? Reasonable, obviously that's self-explanatory. You're not going to go and spend excessive amounts on a deduction that is not relevant to your business. It's ordinary. It's something that someone in your particular industry or your particular business would ordinarily spend money on. So as an example, if you're in sales, you're going to be spending a lot more time dining with people, whereas if you're in manufacturing, you may not. And then necessary. Did I have to spend this dollar to earn another dollar? So don't come and say, hey, took the kids to Disneyland because it made me feel better and I could make more money. It's not necessary for the business, right? And that's where that reg comes in. Yes. So let me just give you another example of where that kicks in is in clothing. I had a matter with the IRS about 5 years ago where a CNN presenter wanted to claim their clothing, wanted to claim their hairdressing and their cosmetics. I lost that case. There was personal use. If you can use something for yourself at the same time as it's a business expense, it's not deductible. Now, if you were a butcher and you wore an apron that you only used in the butchery and couldn't use outside of the office, then yes, you could deduct it. Yes, sir. No, you have to spend it. You obviously can't sit there and watch your client eat, right? It's the intention there is to build business, and yes, there is some personal use, but the predominant use is for your business.
Okay. Real quick, we need to get through the presentation and take some questions and answers.
I'll be happy to sit at the back and run through any individual questions.
Sorry.
All right, you take it away. You take the best practices.
So
away.
The best practices with this is make sure that you plan ahead, talk to your CPA before making any major decisions. Make sure you have your books and records in an organized fashion. You're using some sort of accounting software to keep track of your income and your expenses. That way you can discuss your financial situation with your accountant, and then he can give you the best advice possible on how to go ahead and limit your or reduce your tax liability for that year.
All right, thank you, Umesh. All right, number 3, my pet favorite, poor record keeping. And I've combined that with commingling of funds because often the one is interrelated with the other. So if you are wanting to claim a deduction on your tax return and you're ever examined and you don't have any receipts, you don't have any records, you don't have your bank statements, how do you prove to an IRS examiner that that's exactly what you spent your money on? You can't. And so the challenge here is if you are not able to claim and demonstrate that you have spent that money, you cannot claim it. You need to be in the position where you could comfortably say to an IRS examiner, yes sir, here are my receipts, yes sir, I documented it. Sometimes that documentation requires a reasonable estimate, but most of in substance, you have to have good records. And so I would encourage everybody here, yes, keep your receipts. There are plenty of apps out there that let you take photos. They will let you assimilate all of your information into one place. Go ahead and use those apps, but please make sure that you're keeping on top of your records. A lot of the time we get clients coming in right at the end of the year, just a week before deadline, and they say, here's my shoebox, here's all the stuff I spent my money on. It gives me heartburn, it gives them heartburn, we all cry a little bit, but you know, it's got to get done, and just be consistent with it. It's not that burdensome if you're doing it on a regular basis and it becomes a habit. Why do I mention commingling of funds? So often what I'll see, and I have a specific example which I'll talk about now, is clients are using their personal or their business bank account for personal expenses. So you've just come back from a meeting with Joe or whatever it is, and you happen to pass Macy's and they've got a fantastic sale. You run in and you get a new set of sheets for the house because that's what you really need. It's a good price. You put it on your business credit card because you didn't bring anything else. Well, what you're now doing is you're technically commingling funds. And what I'm going to explain now is what happened, a real life story with one of my clients about 2 years ago. He was in the construction business, works in South Carolina. He sets up metal buildings for storage units. And he happened to go and hire a big piece of equipment to do a job. Unfortunately for him, one of his workers was not very careful. The machine got destroyed and he was taken to court. He said, no, it's in my LLC. I don't care. I'm not paying. Sue my LLC. And it went to court, and the court actually looked through his records and saw that he'd been using his business account for personal use, and made the determination, they did what they call piercing the corporate veil. They made the determination that this was not a separate entity from him, they were one and the same, and he was held personally liable for that damage. So, lesson learned, please, 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 if you want to draw money out of your business, write yourself a check, put it in your personal bank account, and spend the money that way. Okay. Umesh?
Sure. Well, what are the best practices for doing this? Make sure you keep separate bank accounts for your credit cards and your business bank accounts. Keep them completely separate from business. That way you're not co-mingling the funds. Also, make sure you keep a track of your financials on a quarterly or a monthly basis so you know exactly where you stand as far as your financial picture is concerned. It's easier to remember a transaction that took place 2 days ago or a week ago rather than showing up at your accountant's office at the end of the year and them asking you a question. You're like, oh, that transaction was 8 months ago, and now I don't remember exactly what I did and how I used the funds, and if I transferred it from my personal account to my business account to pay for this or anything. So it's difficult to track if you don't stay on top of it. The biggest thing takeaway is make sure you stay on top of your finances and make sure you see a professional and keep track of it on either monthly or quarterly basis. We said we're going to take questions right at the end once we're done, ma'am. Okay, sorry.
Okay, so just on that point again, remember you can use your financials, you can use your records as a tool. Why wait till the end of the year to see what the score was when you could actually be following this month to month and seeing how your businesses are doing? It gives you the opportunity to fine tune, you can change strategies, you can change options that you're potentially looking at and exploring. So it is a far more valuable tool to you, your financials, when you're keeping them up to date. All right, number 4, choosing the wrong business entity. So I've listed up at the top there the different types. You can be a sole proprietorship, you can be a partnership, you can have your limited liability company and own it on your own. You could have a C corporation, an S corporation, a non-profit. These are just some of the entities. There are some other specific ones. There are like personal corporations and other very specific types of entities, but these are generally what you're going to come across. So why is this important, and why does this result in tons of mistakes? So one of the things that I've often come across is where S corporation, a client opens an S corporation and they decide that they're going to buy a piece of equipment or building in that S corporation. Normally it's a building. Very bad idea to have a building in an S corporation. The reason for the S corp and the main motivation you would choose an S corp is because your business is service orientated. It's not something where you're buying a significant asset that you're going to finance. Why is it? What's the distinction? So in an LLC, I can go and I can buy a building and I finance it. I go to the bank, I say I need to fund all of this, and I've got a big amount of debt, and my building generally is going to make losses because I'm renting it out, but I've got depreciation, I've got mortgage interest, I've got property taxes. So from a tax point of view, I'm probably losing money initially when I buy that building. And so what that does is it means I've got negative basis. I have accumulated losses, a negative number. If you've got an LLC and you finance that building with qualified debt, which is normally what a mortgage is, you can take those losses on your individual tax return. In the same exact circumstance, in an S corporation, you cannot take all of those losses. So an S corporation requires that you have basis before you can take losses. And so the minute you go into a negative equity situation, the excess, the negative amount of equity gets suspended. You can only take those losses at some point in the future when you start making money. So it's very important to choose the right entity for the right transaction types or business that you're working on. Okay. Normally what I recommend to my clients, just as a general rule, if my work is all labor-based, it's all my work, it's my sweat of my brow, then I'm going to put it onto an S corporation. The reason I do that is because under an LLC, all of my profit may be subject to self-employment tax, 15.3% for employer and employee Social Security and Medicare. If I'd rather put my structure in an S corporation in that circumstance, I take a smaller salary, which is reasonable, and I only pay my 15.3% on the salary portion, not on all of the profits. So that's the motivation for that. Again, just referring to that qualifier at the beginning of this meeting, for those who missed it, this is general information. Please speak to your professional or your tax professional for specific advice. All right, Mr. Umesh.
So what's the best practices with this? Well, you want to go ahead and make sure you keep up with your financials and you're continuously reviewing your situation on a monthly or quarterly basis. You want to go ahead and make sure that you, as your business grows, have you outgrown your entity structure. So you can start off as an LLC where you're making small amounts of money and it doesn't make sense to have an S corporation at the time. But as the LLC grows and you start to make money and you're making significant payments for FICA tax, like you mentioned, Social Security, Medicare, we want to go ahead and try and save that 15.3%. So as the business grows, you want to analyze how your business is doing, and then you may need to change your structure as you grow. And the only way to do that is to keep a track of your financials and see how you're doing on a monthly or quarterly basis, and having constant communication with your CPA, who can then give you advice and say, okay, this is the next step. Now that your business has gone past this stage, the next stage is for you to go ahead and change it to this, and we advise you on how to take a salary, how to reduce your tax liability.
Okay. Final step, and this is also one that does not always bring a lot of joy to us. We end up dealing with the IRS. They're good people, by the way, folks. They've been through a tough time as well recently, so I don't like disparaging them. But they are adversaries to our clients in some instances, and often cases, this is where our clients have not understood the rules. They may have not been diligent in applying the rules, and so they've ended up missing filing deadlines. They've ignored tax notices, and we end up in pretty tough situations. So what are the main issues that we deal with here? So there are numerous taxes that have very specific deadlines. So watch out for your payrolls. Those all have payroll filings that are due every quarter. Just one issue or one note on payroll taxes is they are treated as trustee funds, right? The IRS, if you withhold payroll taxes from your employees and you do not pay it over to the IRS, they're going to come after you very hard. It's not your money, and they treat that slightly differently from regular income tax. They're a lot more strict about it. So please pay attention to those deadlines. Make sure you're not compromising yourself by not paying over payroll taxes. There are extensions, of course, on all of your income taxes. So whether it's corporate or individual or partnership, you can get a 6-month extension on deadlines. Make sure you submit those on time, please. It's very easy. It's a single form. Send in your extension request, and it buys you more time to gather all your documents. Make sure that you're being compliant. And then just a short note on tax notices. So, we have had a kind of flood almost of IRS notices that have come through. There've been delays. There's been suspension over COVID of sending those out. All of those seem to have lifted at the same time, and so there are a significant increase in the volume of notices that are coming through. We just need to make sure we're attending to them, right? It's not a matter of, oh, here's it came, go leave it on the pile with all the other stuff. Open it up, make an effort, communicate, and see your tax preparer if you're not able to. At least communicate with the IRS. They can delay the implementation of collection activities. They can put a hold on things while you try and negotiate and come up with a payment plan. There are a lot of options available to you, so please don't ignore, rather address stuff and make life a little easier for yourself.
So what are the best practices regarding this? Well, you want to always, like I said before, consult with the CPA. They know exactly when your tax deadlines are, when the payroll taxes are due, when your estimated tax payments are due. And so you have enough as a small business owner just keeping track of when you got to get your deadlines to, or get your products to your customers or whatever that may be. Rely on a CPA or a professional to go ahead and keep you on track with the payroll tax deadlines and any tax deadlines that you have that's associated with the government. So best practices, just keep in touch with your consultant, with your CPA, keep on track of your finances, and consult and meet with them at least on a monthly or quarterly basis. That way you can do some more tax planning and maybe reduce that tax liability, whether that be investing or putting away some money towards a retirement account, a separate retirement account if you're self-employed, or to a 401k if you're taking a payroll. All of these small little things help that can reduce your tax liability now. And then I'm not saying that you're not going to pay any tax, but when you pull it out in the future, when you're hopefully retired and you've got a nice little nest egg, that's when you pull it out, that's when you pay the tax. Because the premise there is that you're not making any money anywhere else, you're retired now, and that tax money will be taxed at a lower tax rate. If you keep the money now and start paying taxes at this rate, you have other income which then can increase that tax rate that you're going to be paying.
Okay. And just a little tip that I sometimes give, like our sole proprietors. You know, cash is king when you're trying to start up your business, you're bootstrapping, it's really tight. My suggestion is to open a separate tax account with your bank, and as you're bringing in that revenue, realize or understand what your tax rate is. If it's 15%, if it's 20%, whatever that number is, go ahead and park that in your investment account, in your separate tax account. And then the goal at the end is to try and get your accountant to give you some of that back, right? But at least you've got your cash available to pay your taxes as you need to, and you know, it's very hard. I understand it's very hard when you've got bills to pay and you're trying to make ends meet. But keeping that tax liability separate kind of almost helps isolate it and keeps it separately identifiable. It's just one of the things that I kind of suggest. All right, Umesh, why don't you run through the takeaways?
So the 5 main takeaways from here, the 5 avoiding the things to avoid taxes is consult with the CPA for a major business. Determine if you qualify for any tax credits. So if you are in constant contact with your CPA, he can tell you that, okay, at the end of month 10, this is how you're doing. We can go ahead and sock away more money towards the retirement account here. You can take a bonus check to try and reduce your liability from the income from the company. So they give you a lot more deductions, credits and stuff that you can qualify as long as you plan early. Make sure your books are clean and organized. You keep separate bank accounts, separate credit cards for your personal and for your company. Make sure your entity structure is the right one for your use now, but always constantly monitor it to see if I need to change that entity structure into something else as your business grows and to help you reduce your tax liability. And then try and be compliant with your tax liabilities and any tax notices. Do not ignore them. Most of the time people get scared when they get a tax notice. As long as you respond to them or talk to them, send them a letter, we can put a hold on collections if that's what it may take. Sometimes it's just as easy as saying that, hey, this was a piece of paper that we didn't file, go ahead and file it. Make sure you stay on top of it.
So I'll give you an example. If you're a stock trader, you might, I don't know, you have an account with Schwab or whatever, you sell some stock and you make a small gain, but the amount that you sold it for was, say, $10,000, and you forget to put that on your tax return. The IRS is going to come back and they're going to say, hey, here's $10,000 of income that you didn't report. Well, your cost basis in that stock might have been $9,000. You might have paid $9,000 to buy it, and so your gain is only $1,000. The IRS is not correct, but they don't know better, right? They don't know what your cost basis is. And so in that instance, the simple filing of a return or sending in a letter will clear up all of that situation. Okay, I think we're good. We're situated at booth 524. We'd love to have you come by and visit. I'll be sticking around here for questions if anybody has any specifically. But thank you very much for attending. We appreciate you.